It's been quite a year in the high yield market after last year's double-digit drawdown. Year to date, through the end of July, the ICE Bank of America High Yield Index has returned just under 7%. That compares to just over 2% for the Bloomberg US Aggregate Index. Triple Cs, which are the lowest quality and most economically sensitive portion of the high yield market, have done even better, generating equity-like returns of nearly 13%. And this strong performance has occurred despite tightening monetary policy, an inverted yield curve, a mini banking crisis, and widespread expectations that a recession is just around the corner. So where does that leave us now? High yield spreads, which is the compensation that investors earn for taking credit risk, are inside long-term averages, but they're wide of both the post-pandemic tights and the all-time tights. Now, spreads could tighten further, but at these valuations, we kind of think the market is discounting a no recession scenario. Now, it's certainly possible that what we're experiencing is really just a normalization of the global economy after the pandemic led to historic demand and supply shocks that in turn induced a historic fiscal and monetary policy response, and maybe we will avoid a recession after all. But in the past, when the Fed has tightened this much, there has ultimately been a recession. So we do think, at this point, some caution is warranted. Now, we are seeing some evidence of tighter monetary policy in the high yield market. Currently, roughly 20% of the high yield market matures in the next 3 years. This so-called maturity wall is at the highest level that it's been at in over 2 decades and has been driven by the dramatic increase in rates. What do we mean by that? Well, we believe the maturity wall grew in part because many issuers have waited to refinance maturities because of the higher interest rate they'll have to pay on a new bond. For example, for double B and single B issuers, we estimate they will have to pay roughly 2% more when they refinance. That's a headwind for those companies, and there will be winners and losers, but ultimately, we don't necessarily think this derails the market. Story for triple Cs is a bit more challenging. The average triple C issuer will see its interest cost increase by approximately 6% based on current market rates. This is a very big increase, and many triple C issuers may struggle to make those higher coupon payments. While there is reason for caution, we don't think now is the time to panic. The average rating of the high yield market is low double B, as high as it's been in many decades, and the percentage of triple Cs in the market is close to historic lows. High yield issuer fundamentals are solid as well, with leverage near the low end of the historic range and interest coverage near the high end. And while I noted earlier that Fed hiking cycles often lead to recessions, there is typically a period of a year or more following the last hike in which high yield performs relatively well. For example, right now, double Bs and single Bs yield almost 7.5%. For those of you who may be worried about rate volatility, you can get a similar yield in short maturity double Bs and single Bs. The key, however, is that investors take care to pick the winners and avoid the losers. We do think you should probably avoid the refi risk of triple Cs. And in any event, if triple Cs do well, it's very likely equities will do even better. In short, we believe short maturity, high quality, high yield bonds can offer investors the opportunity to compound attractive real yields right now while keeping volatility at relatively low levels, despite all of the ongoing uncertainty.